Well, a very warm welcome to you. We're going to do a quick look at the interest rate markets today, starting with the 2-year Treasuries and working our way up to the longer term duration. Starting with the 2-year Treasuries, we can see a longer term chart going back to last August and the rapid rise in the 2-year Treasury market. And this is an end of day chart, so it was actually as of the end of the day yesterday. Let's move on to an updated chart. We're looking at today's move up 8.4 basis points currently. That's a big move higher. Closing at they're currently trading at 3.244% on the 2-year Treasuries. The most interesting chart out there right now has to be the 2/10 yield curve, which is at negative 0.22%. And as I look at my notes, if you look at the August 2019 period, there's a short-term period of 3 days in August 2019 where we had a negative yield curve. At this point, we're much more firmly entrenched, and we've got 10 consecutive days and counting right now of a negative yield curve. And so it does look like the yield curve is normally indicative of a Fed policy error. That's my interpretation, at least, which leads to typically leads to a recession. And in this case, it's not going to lead to a recession because it certainly appears that we are in a recession. So we're tightening in a recession to get a handle on inflation, apparently. I can't say that I agree with that policy, but anyway, let's move on to the next chart. We're looking at the 10-year Treasury chart. There's a 20-year chart of the 10-year Treasury note, and you can see I've got the circle up here in the 4% range over on the left-hand side. That's basically where I think ultimately the market goes. I think that's the target, and we put out a video last week saying, have we hit a peak in rates? And I'm going to answer my own question. I don't think we have. I think we're going to be heading higher. And I think all we were going through is a short-term correction. And you will see a continuation of a Treasury sell-off and consequently higher interest rates going into, in a recession simultaneously with a recession. That's not a good recipe for economic growth. And if you look at the last 18 months, we can see since August, actually 2 years, since August of 2020, and we can see the the trend lines that we have for higher interest rates. These trend lines have served us well, and I would expect they're going to continue to serve us well. So anyway, let's move on. The 30-year Treasuries tells basically the same story of the 10-year. 30-year Treasuries moving on. Not a lot to add coming from that chart. Trading right now just basically a shade under 3.2%. Moving on to the mortgage markets, we're looking at a 5.73% interest rate on the 30-year fixed. That comes from Mortgage News Daily. And then real quick, we have a chart looking at purchase loan applications. Going back, if you take a look at, for example, the last 18 months to January of 2021, we could see a drop from the purchase index of 348 down to currently we're looking at 232, approximately a 30% drop, which does make sense. We've got the higher interest rates, which would coincide with lower mortgage applications. So makes perfect sense. Finally, the news that we put out a video earlier today, we're looking at the GDP Now estimate. Let's scroll up just a little bit from the Atlanta Fed, and coming on down, we're at negative 1.6%. That was with today's housing data that came out. Basically seals the deal, second consecutive quarter of negative GDP growth for Q2. What more needs to be said? I think we're basically in a recession right now as we speak. So Fed raising rates into recession, The talk is they're going to be going 3/4 of a percentage point next meeting. I guess it puts some pressure on the September meeting because they've been talking about a 50 basis point rise in September. We'll see if that comes to fruition. Anyways, that's about it for today. I thank you very much for joining me, and we'll talk to you again soon. Bye-bye.